Okay, thank you all for being here. And thank you to the Graduate Tax Program and the Institute of International Economic Law for co-sponsoring this event. So as many of you know, the institutions of the European Union have been active in the tax area for many years. For the first few decades, most of the activity happened in the indirect tax space, the VAT directives and the like. But the European Union has recently become much more ambitious in the direct tax space. Many Americans are most aware of the actions of the Directorate General on Competition. Those are the recent state aid investigations of tax rulings. But there have also been many other direct tax developments outside of the competition space in the last few years. Now, a few years ago, the EU announced a plan to ensure fair and efficient corporate taxation. And this has involved multiple parts. This has included an anti-tax avoidance directive, which was adopted by the Council in June 2016, proposals for both a common corporate tax base, the CCTB, and a common consolidated corporate tax base, the CCCTB, and a focus on tax transparency, which included a tax transparency package and a pledge to produce a list of non-cooperative jurisdictions in the next several months. And in the last few days, the European Union has been in the news with the possibility of an equalization tax or a similar levy on the digital economy. So given all that, this is a perfect time for us to hear about the Commission's views about the EU's tax agenda. And I'm honored that we at Georgetown can introduce Stephen Quest, who will provide us today with an overview of the next steps of the EU's tax policy agenda. So Stephen Quest is the Director General for Taxation and Customs Union at the European Commission. He joined the European Commission in 1993, and he has held his current position since January of 2016. Most recently before that, he had the positions of Director General for Informatics and Director of the office that administers and pays the financial entitlements of the staff of the European Commission. Prior to that, he has held positions in the Commission across different policy areas, ranging from the environment to employment and social affairs. And prior to joining the European Commission, Stephen worked for the UK Department of Employment and the UK Permanent Representation to the European Union. Please join me in welcoming Stephen Quest.
Thank you very much for the introduction, and thank you all for coming here today to listen to me at 9 o'clock on a Friday morning. And I'm in competition with my Prime Minister, who I believe is speaking in Florence roughly now as well. So I'm very grateful to you for joining me here today. And I apologize for my voice. I've been in DC most of this week talking to various folks, and I've maybe talked too much because I'm starting to lose it a bit, but I'll do my best to get through the things I want to share with you today. And it's a real pleasure to be here to share my perspectives on the EU tax policy agenda and how it fits together with the international agenda. And I really think I picked a good time to come to DC and to have these conversations this week, because it certainly seems to me to be one of the hottest topics in town. There's a sense of anticipation here for the domestic tax reform package that's being prepared. And I think that's quite understandable. It's going to have a big impact on citizens and on businesses here. And of course, we in Europe are very curious as well to see the detail of that US tax reform, particularly in the area of corporate taxation. And I think there are at least two good reasons for our interest in what you're doing here. The first is because business tax reform here is going to have an impact beyond the US. I think that's very clear. Our economies are intertwined, and whatever happens on the US tax system is going to have reverberations worldwide, I think. So we're naturally very curious to see what changes might come and what effect they're going to have internationally. And I think the second reason why it's interesting for us is that we're also undergoing major tax reforms in the European Union, and some of the factors that are motivating our reforms, I think, are similar to the kind of things that you're discussing over here too. In particular, on the one hand, the need to modernize tax policy, boost competitiveness, growth, jobs. How can we get tax policy in shape to do those things? And on the other hand, how can we use tax policy to ensure and restore fairness as well? And we see these two things as being mutually compatible. There's a certain dependency between them, but we see them as two sides of the same coin and not incompatible. But it's a challenge to get the balance right, of course. And, you know, I think our take would be that it's difficult to ensure sustainable economic prosperity if you maintain social inequalities and market imbalances. And so you need a sustainable tax model to try and address those imbalances. Otherwise, you will remain out of balance, and that's not really where we want to be. So our EU tax agenda is focused on addressing these two goals, fairness and growth, in parallel and intertwined. So as the US is launching its own tax reforms, I think it's a major challenge that's faced there. It's going to be interesting to see how those two approaches align and where they diverge, if they diverge, and what that means for us in the international tax policy space. So what I want to do today is give a very brief overview of our work in the EU on tax policy, picking up some of the points that you've already mentioned, and what we're doing to try to establish this fairer, more effective, more growth-friendly taxation framework for the Union. I'll start with fairness. Tax justice has become one of the highest political priorities in Europe today. And I think the pace and scale of the reforms in the tax agenda that we've been pushing and I think promoting quite successfully serve as proof for that. It's driven in part by media scandals and by leaks of information which have exposed large-scale corporate tax avoidance, tax evaders' offshore activities. I think in Europe at least rubbed quite a bit of salt in the wounds of citizens who'd been dealing with the consequences of austerity and economic downturn, and they felt that they'd borne the brunt of this during the financial crisis. And so, seeing that tax avoidance was fairly endemic, I think, made that much worse. And so, we saw an urgent need to rebuild trust in tax systems, so that citizens could have confidence, so that businesses could compete fairly, and so that member states' revenue bases were protected. And all of those three aspects are important. So you've got citizens' concerns, you've got business concerns about fair competition, and member state concerns about protecting their revenue bases and avoiding abusive tax practices. So our agenda was, in a sense, relatively straightforward, based around a few guiding principles. All companies, whether they're large or small, should pay taxes where they make their profits. And all taxpayers, whether they're rich or whether they're poor, should pay no more but also no less than their fair share of tax where it's due. And guided by those basic principles, we set out on a campaign to tackle this issue of tax fairness. I'll give you a few examples of the kind of actions that we've done. The first was to raise the level of tax transparency within the European Union so that tax authorities can have a better picture of what's actually going on. Under these new EU rules, tax authorities have agreed to exchange really an unprecedented amount of information between themselves on VAT, on tax rulings, on multinational reports, on financial accounts, and coming soon on beneficial ownership. So a very high degree of transparency between tax authorities, and this will equip them, excuse me, I'm sorry, this will equip them to spot harmful practices which are impacting their tax bases and to react more quickly against abuse. Now, we also want to hold the corporate sector itself more to account, so we've proposed transparency requirements as well for multinationals, including public country-by-country reporting. It's been controversial, but I think the proposal is a relevant one and out for debate. And also requirements on tax advisors or so-called intermediaries. Again, more transparency in that area, which is an opportunity to deter those involved in aggressive tax planning through transparency requirements. And also an opportunity to restore and rebuild public trust and help rebuild reputations that have been damaged by the kind of leaks that we've seen in the Panama Papers and elsewhere. Now, our next line of action was to bolster the arsenal against aggressive tax planners and those that encourage them. And to this end, member states agreed binding new anti-avoidance measures which come into force in 2019. Now, these common anti-abuse provisions, it's the so-called ATAD directive. We love acronyms in Europe, I'm sorry, but so the Anti-Tax Avoidance Directive will shut down some of the most prevalent channels of tax avoidance. And in addition, we've used our state aid tools, where relevant, to tackle harmful tax competition within the EU. We also have a peer review body, which is called the Code of Conduct Group, to ensure that member states' regimes are fair as well. So that's peer review by member states of each other's regimes to ensure a high standard and no harmful tax practices. The final thing to mention here is that we've not limited our fair tax agenda to the confines of our own single market. We've also pursued an external strategy to promote good tax governance abroad, globally, and to try to deal with countries who defy those rules or don't want to comply with those rules. So we've got a transparency pillar, an anti-avoidance pillar, and an external pillar as well in this action to reform the tax agenda. And I think it's important at this point to emphasize, of course, I think it's obvious to you, but just to underline it, that we're not acting alone in the EU. We're also part of a broader international agenda of tax reform, looking for fairer taxation. We're very much aligned to the work of the G20 and the OECD on tax transparency and the whole base erosion and profit shifting initiative. And I think that's been extremely important for us. We've worked hard in the EU to try to be a leader in that process. When it comes to international tax good governance, we've tried to address all of the OECD BEPS measures through hard law or through soft law. And all member states have now implemented the new international transparency standard under binding EU rules. So there I'm talking about the common reporting standard, country-by-country reporting. So we've worked very hard to rapidly implement on the statute book measures to actually comply with BEPS. Obviously, as we do that, we very much hope that our international partners will do the same, and we would like to see those commitments being implemented quickly and consistently. And I think it goes without saying that the international fight against tax avoidance is really only as strong as the weakest link, and that's why we put quite a lot of emphasis on the external side of our work as well as the internally facing EU side. Now here, on the one hand, we're looking to collaborate with countries and promote good tax governance. We provide a lot of support to developing countries. We know that they're often, on the one hand, hard hit by multinational tax avoidance. They have a lot of difficulty dealing with that because of their administrative infrastructure, and they often lack the resources to deal with it. And so we're looking at ways to help engage with international partners to try and resolve those problems. We also work very closely with international partners. One of the reasons I'm here today and this week in the US is to have those kind of conversations about how we can progress the international tax agenda. Now, of course, the other side of that is that what happens if all of this work doesn't succeed, and we are confronted with jurisdictions that remain non-cooperative. For that reason, our member states in the European Union have been working on a blacklist of non-cooperative tax jurisdictions, which they intend to have ready by the end of this year. This is a new process that's been put in place. It's going to reflect the outcome of a quite intense screening and dialogue that member states have been running with selected tax jurisdictions where there were potentially problematic practices. That process will be completed by the end of the year and accompanied, if appropriate, by countermeasures against the listed countries, the nature of which is still being discussed by our member states. It's a process that's evolving in real time, but the idea is to make it a procedure that has teeth at the end of it if that's required. I would, of course, underline that the listing process is very much designed to be a last resort option. The idea is not to be the policeman coming along with a big stick, but the idea is to nonetheless ensure a degree of fairness in the global tax environment, and where all other avenues are exhausted, well then the listing, I think, can play a deterrent role for those that really consistently undermine international tax good governance and don't wish to conform. So I've spoken at some length there about fairness. I want to move on now to the other key objective that's driving our reform, which is growth. It's growth, jobs, competitiveness. How can we use tax policy to support those objectives in a positive and forward-looking way? And what we're trying to do, in a simple sense, is shape a tax environment for our single market in the European Union that will allow businesses and investors to thrive. Now, I think the first thing to say is that I can understand that some people might have the impression, given the list of things I've already listed about anti-tax avoidance measures, that we have a sort of anti-business agenda. I would argue it's quite the opposite, and that what we're doing is actually a very pro-business agenda, because the vast majority of companies are not engaged in tax avoidance. And so they are suffering competitive distortions as well from the anti-competitive behavior of the minority. What our studies show is that smaller domestic companies are carrying a 30% higher tax burden than their multinational counterparts due to aggressive tax planning. So the anti-avoidance agenda is important, an important part of securing a fair and a level playing field for companies in the single market, so that everybody can operate on the same basis. The second thing to say in favour of the coordinated EU approach to corporate taxation is that it helps to prevent the legal clashes, the administrative burdens, the compliance costs that come with having 28 separate models, which is the default starting point in the European Union. In our single market, the more we coordinate, the better for business that it becomes. It creates stability, it creates certainty, it creates ease of business for cross-border companies, and it can remove important tax obstacles that can hamper their activities. And I think that's a very important consideration to bear in mind. Now, beyond the coordination work, we're also working to improve the tax environment through our legislative framework. I'll mention three things there. The first is that we're carrying out a fundamental reform of our VAT system, the value-added tax system, with again a strong focus on reducing costs and complexities for business. So here, for example, we want to change the VAT rules for e-commerce, introduce a one-stop shop system, and we believe that this alone will cut compliance costs by up to 2.3 billion euros a year. The VAT system, as it's framed, is relatively complex, and so there's a lot of improvement we can make there, and we're going to be continuing to work to reduce that complexity. Second thing to mention is the new EU mechanism to resolve double taxation disputes. Double taxation is a huge source of uncertainty for business, especially smaller business, and it can be very expensive and time-consuming to resolve. And so we put in place a new mechanism so that companies can have a quicker and a clearer and a more definitive process to solve double tax disputes when they arise. So another important business-friendly measure. And the third thing to mention is the Common Consolidated Corporate Tax Base. I said we love acronyms. That's the CCCTB. And this is really, I'd say, our most ambitious project, because there we're seeking really to overhaul the corporate tax regime in the EU. And even if the details are quite complex, I think the basic idea is pretty simple. With the CCCTB, business would only have to deal with one set of rules, one administration, when filing consolidated corporate accounts for all of their EU activities. So it's stripping out the complexity of dealing with 28 different administrations for multinationals or businesses operating across the European Union. Now, we've recently relaunched negotiations on the CCCTB, and to try and push for progress, we've added in extra benefits for business beyond the core aspects of consolidation and the common base. One thing we've done is introduce proposals for incentives for growth-friendly activities like equity financing and investment in R&D. And these incentives are designed to be especially generous for SMEs and startups, which we see as the real engine for growth. And we want to frame the tax regime in a way that incentivizes those smaller companies and startups to invest and not be held back by the tax regime. So the CCCTB is designed to be simple, streamlined corporate tax system, aligned to this growth agenda, removing administrative burdens, cutting compliance costs and legal uncertainties. It also loops back to what I was saying earlier, the fairness agenda, because it will also tackle some of the remaining anti-avoidance issues that we're confronting. It will be a mandatory regime. The earlier proposals were for a voluntary regime. We think the mandatory regime will create a more level playing field, and it will help eliminate mismatches, loopholes, special regimes that are exploited by tax planners. It will have an apportionment approach, so allocating profits between member states, and create a stronger link between economic activity and taxation. I think that's another strong argument in its favour. Now, to start to wrap up, the CCCTB and the other tax initiatives that I've tried to sketch out for you today, I think you've heard, are all designed to create a fairer and a more competitive tax environment, not just for now, but also for the future. But we're under no illusion that if we just do what I've set out there, we're finished and we can shut up shop and go on and move to a different policy area. It's an evolving agenda, and given the rapid rate at which business models and the global economy is evolving, I think we've got plenty of work ahead of us. And when we look ahead, I think the challenge we see coming, and you referred to it in your introductory remarks, is now the digitalized economy, which is fundamentally changing the way business is done. Now, our take here is that the traditional international tax framework is not really equipped anymore to respond to some of those challenges. And so taxing the digitalized economy has become an issue of relatively pressing importance, politically as well as economically. That's why yesterday, in fact, the European Commission published a communication on fair taxation of the digital economy, which is a first step in helping to shape a coherent EU position on these challenges. This topic was already given high priority in discussions between European finance ministers at an informal meeting in Tallinn last weekend. And I think, given the rapid rate at which the digitalized economy is evolving in all its forms, that the feeling coming out of that discussion was that this is not really an issue that we can ignore. We actually have to now get to grips with it and tackle it. As a global community, we need to come together and find workable solutions to taxing the digitalized economy in a fair and growth-friendly way. Now here, I think the US has a particularly important role to play in the global process. It's the co-chair of the OECD task force on the digital economy. And I think we need to work together for an innovative and an appropriate response so that the international tax framework fits with modern-day realities. On the EU side, we're, I think, very committed to contribute in every way we can to this agenda. And we are looking forward to the OECD's report, which is due to be published in spring of next year and feed into the G20 discussions. And on that note, really, to conclude, I just want to underline our commitment to the international agenda for fair and effective taxation, the importance of the EU-US dialogue on these questions. We may not always agree on everything, but I think the depth and strength of that dialogue is extremely important. And as the world's largest economic blocs, I think we have a duty to lead by example and try and steer the global tax agenda in the right direction. Our domestic tax agendas and our international responsibilities should go hand in hand. We're struggling, each of us, with the domestic issues and the ripples that they have in the international agenda. I think it's important to work together. And as we go forward, I think we need to remain guided by the overarching goal of securing fair, effective, growth-friendly taxation for all businesses and for citizens now and in the future. Thank you very much.
Thank you.
Thank you.
So I'll start off with a few questions, and I'm guessing that our audience has a lot of questions as well. So first of all, you mentioned when you were talking about the business-friendly element of the agenda, you pointed out that smaller domestic companies need to have a level playing field. And in the United States, oftentimes when we read stories about European tax, we read about the European tax proposals or the agenda itself as targeting U.S. multinationals. And so this is particularly true in the context of the digital economy, but this has been true in the context of state aid and in the context of many of the anti-tax avoidance measures as well. So what's your response to that view in the United States as the European Union essentially going after U.S. multinationals through this agenda?
Yeah. Well, I don't think it's true. Is my simple answer to it. I mean, the global anti-tax avoidance agenda, which is framed in the BEPS initiative under the OECD, is a global agenda, and it's been framed in the OECD for that reason. And the US is a very active partner in that process. So the vast majority of the work that we've been doing has been at EU level recently implementing that agenda. Now, as I said in my remarks, we've tried to lead from the front in terms of an ambitious implementation and rooting that legislation in the legislation. And I think we've done good work in getting there rapidly, and that's why we're keen to see others following. But and the state aid aspects, yes, there have been some state aid cases that have impacted US firms, but there are many state aid cases that also impact EU firms. So I think everybody, the rule book is the same for everybody, whether they're big, whether they're small, and wherever they come from, whether they're operating out of. And I think that's, we're looking for a level playing field, and therefore we have to have the same rule book for everybody.
So let me follow up on your reference to the global OECD agenda. So during the BEPS project, 22 of the EU member states were represented themselves as part of those meetings. So what interaction do you see where the EU's agenda is necessary to push forward what's being agreed to in the OECD, or do you see the two working in parallel? How do you see the interaction between the EU's agenda and the overall global agenda that the United States is part of?
Well, I think that they fit well together, and you need to ensure there's a synergy between them. There's no point having action in the OECD going one way and the EU going the other. That would be very incoherent of us. My belief is that we've been quite successful in ensuring that synergy. The thing that we also bear in mind when doing EU level action is our single market and the need to frame the laws in a way that are coherent with the single market principles. So on the anti-tax avoidance action, we were very keen on the one hand to ensure rapid implementation of the commitments that have been taken by the European members of the OECD. And we were very keen as well to see that done in a coherent, unified way, and that we didn't have 28 different flavors of BEPS implementation emerging across the EU. That's why we were rapid in coming in with our directives to ensure this coherence.
Great. So you mentioned the CCCTB. The CCCTB has been around. It was mentioned at the latest in 2001, although there were mentions of it before. There was a non-paper, one of my favorite developments, in 2004. There was a proposal for the CCCTB in 2011. And so now there's a new proposal, and it's a two-step proposal. And I have a few questions about that. And so the first question is, why do you think that this is the correct time to relaunch this, and why do you think it's more likely that this will succeed this time? I know you mentioned that it's more business-friendly, but it's also mandatory, which one could argue is less business-friendly than an optional CCCTB. And also, do you see the CCCTB as essentially the ultimate goal, with things like the digital tax or other developments essentially pushing toward the CCCTB, or do you see that as something that is separate and apart from some of the other developments that you mentioned?
Okay, thank you. It's an important proposal for us, and you're right, the idea has been around for a while. We've come back to it recently, last year, with a revised and refined approach, because we continue to believe that it is the right approach and it is the most credible long-term solution for the tax challenges in our single market. So we remain very committed to it. Why is now the right time to come back? I think it's partly driven by the attention continues to be given to anti-tax avoidance. And as I said in my remarks, some of the aspects that we baked into the CCCTB proposal will further enhance our ability to tackle tax avoidance issues in a joined-up way. And I think the time is right. I mean, the time was right when we first tried. The time is still right because we need to offer businesses a simpler tax system to do business in the single market if we want to remain competitive and if we want to remove the complexity and the compliance costs. And this is what we hear from business. So it's a pro-business proposal, and we have the support of business. The trick or the challenge for us is aligning what we're proposing with the specificity of the existing corporate tax regimes in our members, because it involves adjustments, and adjustments in tax regimes are difficult. And I know that you know this with what's going on in Washington right now on tax reform. It's yes, it's now mandatory, and it's only mandatory in the proposal for large multinationals, over 750 million. So again, we've aligned with the OECD, and we thought that was the better approach. Companies under that size will be perfectly welcome to use the system on a voluntary basis, but the mandatory part is only for the larger companies. Does the CCCTB offer the vehicle to resolve the challenges of the digitalized economy? I think, and we say this in the communication that we put out yesterday, that it does have the potential to be a vehicle to resolve those issues as well. It would need some further adjustment to take account of those challenges. I think it's perfectly possible to do that. And that's one of the things that in the communication, we say three things. We need a global solution. The CCCTB can provide a solution long-term at European level, and we may need to look at shorter-term solutions as well. So I think it definitely could be part of that mix.
Well, let me open it up to others. I have many other questions if there are not enough questions in the room. But are there questions from the audience right now? In the back?
You mentioned the existence of distinct issues about the digital economy. Can you say a little more about what the administration or nature of the operation of the business, or the way that it extracts money from its own operations and user data? What would fit a business in your digital category, and what are some of the reasons to tax it differently?
Okay. Well, I think some of the answer to your question can be found in this communication. So we can give you the reference to the communication after the presentation here. But to try to sum it up, what we see is that the current tax rules, as they are framed, struggle to capture some activities which are increasingly based on intangible assets and on data, which is facilitated by the different business models that we've seen emerging on the back of the digitalized economy. And so if you're providing these services in a different way using new business models, there is a potential mismatch between the traditional tax system, which looks at physical assets and physical permanent establishment, for example, in a country, and are you established there physically or not, and that will then trigger a certain series of tax consequences. And in this more digitalized economy, you see a large amount of business being done without any physical permanent establishment. So we talk about virtual permanent establishment. There's no definition of that. And if you have no definition of virtual permanent establishment, you can't establish taxing rights. And if you can't do that, well, then you have a challenge in aligning your traditional tax system with new forms of doing business. Now, new forms of doing business are fantastic, and it brings growth, and it brings jobs, and it brings advantages for citizens, and there is no problem with any of that, of course. It goes without saying, but I'll say it anyway just in case. And the tax system also needs to be able to capture that activity, because if it fails to do that, the tax burden falls elsewhere. And then there's an unfair tax burden falling on the more traditional forms of activity versus the more digitalized forms of activity, which are able to sidestep some of this.
So I have just a question about the process. I'm not a tax expert, but I am very curious about the process for the blacklisting, particularly of your third-party jurisdictions. Number one, if you can sort of spell out how that process in general plays out. Number two, even before you get there, you're obviously going through peer review, as you mentioned, peer review mechanisms and other mechanisms to assess other jurisdictions' fiscal policy. Slightly related is how will Brexit impact that process? Will there have to be a re-evaluation of not only your current third-party jurisdictions, but also those for that member who will become one? Those are my two questions.
Okay, thanks. Great questions. So the listing process fundamentally works as follows. In the first phase, we looked at all of the tax jurisdictions across the world with whom the European Union interacts to see is there a level of economic interaction that makes them relevant, and to see as well whether there were potentially issues that we thought merited exploring further. And that was the first step, and on that basis a dialogue was engaged with somewhere over 90 different countries across the world to get into this dialogue, peer review, screening process. And fundamentally what the screening process is looking at is three things. It's looking at have these jurisdictions complied with the transparency criteria flowing from the OECD. And the OECD has also in parallel been doing that screening process, and so we've been dovetailing, I'd say perfectly with the OECD on looking at the transparency criteria. But we've also looked a bit beyond that focus on transparency that the OECD has been using, and we've looked at two other things. The first is the level of BEPS implementation. It comes back to my level playing field argument. If we've gone fast in Europe to implement, we want to see, well, you know, how are the other jurisdictions doing, and is this opening up distortions between us that we need to be concerned about? And the third thing that we're looking at is harmful tax practices. Do we see in the ecosystem of these jurisdictions practices that we might consider to be harmful and want to look at? The criteria there being the work that we do within the EU in the Code of Conduct group. So the Code of Conduct group, as I said, is a peer review process between member states where they look at each other's regimes to ensure that there's no harmful tax practices within the single market. And we want to apply that kind of criteria when looking at third countries as well. At the end of that process, and this screening is being done by member state experts, it's not the European Commission on its own looking at this, it's member state experts grouped together. They will make their recommendations at the end of the year to the ministers, who meeting in the council will decide whether or not to adopt a list and who to put on the list and what measures, if any, to take against those jurisdictions. On the issue of the United Kingdom, at the moment, of course, the United Kingdom is inside the EU and therefore covered by the Code of Conduct process. If and when the United Kingdom leaves the European Union, it becomes a third country, and the assumption, I guess, is that it would then be covered by a future iteration of the listing process, assuming that that's still relevant and still running.
Thank you.
So thank you very much for being with us. Okay, it's a pleasure to have you here. You have made one claim over and over, which I want to push on, which is that the European Union is aligned with BEPS and the G20 and acting in good faith to cooperate internationally. Actually, this seems to me, to put it gently, at least by the current standards of U.S. political discourse, to be a lie. Why do I say that? There are a series of agreements with the member states of the European Union and the EU itself at the G20 and the OECD level have agreed to, which were compromises agreed to after a very heavy negotiation. Agreements are meant not just to be implemented, but to respect their limits. And less than 2 years later, you are, for example, pushing public country-by-country reporting, which was explicitly rejected in negotiations in the BEPS, OECD, and G20 process, pushing an equalization measure that is sector-specific and therefore, as a practical matter, targets by revenue almost exclusively U.S. companies. And with state aid actions, you effectively have engaged in case-by-case retroactive taxation through a mechanism for determining where you will and will not enforce that is contrary to the rhetoric you used about the tax agenda, anything but transparent. And these are just two examples, all of which conflict with the OECD and G20 agenda. Basically, what we have is the member states in their so-called sovereign capacity leading at the G20 and OECD level, and then a year later, or 2 years later, the EU, with the member states contributing, but with the EU claiming supra-sovereign leadership, basically disavowing the commitments of its member states made at the global level, with the EU acting as an observer. So one response from an American perspective is, why should anyone make any agreement with the EU or its member states ever again? How can we trust agreements with the member states? Should we only agree with the European Commission or the European Union as a whole? The problem is that from a U.S. perspective, at least from my perspective, one wants a productive way forward. And so the question comes, and I will pose it to you, what aggressive steps should the U.S. try to take to channel European instincts so as to create an environment where international agreements that actually stick are possible again?
Thank you. It's a very long question. It came in several parts. I'm just reflecting because I'm on the record here, and I normally like giving really frank answers to questions, but I need to be a little bit careful. On your first premise, which is that the EU has not played fair in a sense. I mean, I don't buy it. I think, on the one hand, the EU went into the OECD BEPS discussions with the ambition of leading and collaborating positively and having an ambitious outcome, and that to large measure, with the other partners, we succeeded in that. I don't think we accept the argument that you can therefore only do what's in BEPS and nothing else around, when it's quite clear that in part of the BEPS outcome, there were, as you say, compromises or simply solutions were not yet found. I mean, BEPS 1 is an example, which is the digital economy strand, where it was discussed, there was no real outcome, and I think that there you see, in Europe, the pressure coming back saying, well, okay, now we need to come back to this. And the message on that is very clear. It's not, and I don't accept your point on the equalization tax, and by the way, in the communication, we don't propose that. What we say is, we think this remains an important issue, and we need to find an international solution. The OECD and the G20 is the place to do it. Please, everybody, engage and help us find a way through. We also say we think it's sufficiently important that if that doesn't happen, we may need to look at how we tackle that domestically, because we believe it to be an important issue for us, including in terms of protection of the revenue base. But I don't see it as being incompatible with BEPS. I see it as being a complement to and a call for further progress on BEPS. On public CBCR, I take the point, and of course I've heard this many times, that in BEPS it was agreed that we would exchange information between tax authorities, and this would not be public. That's what we've implemented. And now it is true the Commission has made a proposal to extend that to a more limited data set, and to make some of that information public. I think that plays to our discourse around transparency and around fairness and around citizens wanting to see that large multinationals are playing fair. And honestly, when you look at some of the evidence that comes out of the various leaks that have happened, you can understand why citizens might be a little bit skeptical that everybody is playing fair and that they may actually want to see some of this information. And so I think there's a genuine argument there about how far you should go, and that discussion is happening within Europe. It's a controversial proposal within Europe, but also internationally. On state aid, well, the state aid rules have been there for a long time, so I think the the retrospective view of it is one thing, but I think that the rules were there, and the state aid process is actually relatively transparent. Well, okay, we can discuss that maybe offline. But your question at the end was, well, then, so what should the US do, or what should the position be? I mean, here I think the answer is we need international engagement. And it's something you'll hear from Europe on every subject. And I mean, I could list some other subjects, but I won't go there, where we remain committed to international engagement and to maintaining agreements that either have been made or we're trying to make. And we want that engagement, whether it's on tax or whether it's in other policy areas. And at least that's very much the spirit in which I've come here this week to have discussions with my counterparts. And
so is the problem to engage with the European Union and the European Union alone? To basically say, we're just there. We have to stop engaging with the member states. And if not, why not?
No, not at all. I mean, I think the solution is to engage internationally in the G20, with the European Union. In the European Union, we do a lot of work to coordinate our position so that we don't have 28 different flavors of position for our international counterparts. And I think that's, we do a lot of work to do that, and I think relatively successfully, not just in tax, but in other areas as well. But I hear that you have a different take on it, but it's fine.
Hi, thank you. Do you believe that some members that even align with the new proposals will face more administrative burdens while implementing these proposals? And if yes, how are you planning to shorten these issues for between the members of the European Union?
It's a good question. I think each member state reflects carefully on that when agreeing to the measures, and I think they're best placed to have a view on their capacity to implement them. Fundamentally, a lot of this is driven by international commitments, and so they have an obligation to do so. We have programs in place at European level to help tax administrations within the EU to work together to exchange best practice. And so that's one way we can help them to comply. We actually do work at a technical level to build the IT systems, the platforms, to facilitate the exchange of information, for example. And so underpinning the different iterations of the Directive on Administrative Cooperation, which is the vehicle that we've used to implement the exchange of information on tax rulings, on country-by-country reporting, and other aspects that I mentioned. Those exchanges technically will happen through a common platform that we in the Commission will build and supply. But we won't get the information. That remains with the tax authorities, but we will enable those exchanges to happen. But capacity building in tax administration is something that we do also work on quite intensively.
Hand back there. Yeah.
As you know, the directive around tax abusive schemes has some pretty draconian penalties that apply to basically attorneys, accountants, financial facilitators of the transaction. And what is seeming to happen is that there is some difficulty in interpreting what constitutes legitimate tax planning at the moment. And the United States went through this process as well when they were attacking abusive tax shelters and so forth. And acknowledging the fact that there were some abusive transactions, Panama Papers revealed that. But for the profession that's interested in assisting clients in legitimate tax planning, do you foresee the possibility of getting a little bit more definition around tax abusive transactions in a manner that at least perhaps you could look at how the Internal Revenue Service in the United States stepped up and provided some guidance so that when clients call the advisor can legitimately give them good advice that doesn't want to follow the rule, since the profession as a whole wants to cooperate with the EU as well as our own government taxing system here in the U.S.?
Yeah, thank you. It's a very fair question. I think One contribution to that is the proposal we have under discussion at the moment on intermediaries, which is really the implementation of the disclosure aspects of BEPS, I think BEPS 12, where we are trying to exactly put in place an EU framework that will guide intermediaries, advisors, in whether they should or shouldn't disclose, what are the hallmarks that they should be looking for in reporting schemes to the tax authorities, so that they also can have the confidence that what they are doing is the right side of the line. It's something that exists in some of our member states, in the UK, I think in Ireland as well, and that we're trying to put in place at European level. So that's one part of the answer, but I accept that it's that the need for certainty is not just the need for certainty for business, but also for intermediaries, and that there are legitimate tax planning considerations that we need to be able to take into account.
Yes. And hopefully this is an easier question. My question relates to evolving industries such as the tobacco industry and next generation products. Do you anticipate the Tobacco Products Directive opening up to some of these less harmful products, especially with respect to tax and customs, the TPD?
It's something that we're looking at, and we are currently doing a review of the Tobacco Excise Directive. Not the Tobacco Products Directive is not under my remit, but tobacco and other forms of excise is. We're doing a review of that, and there's a report going to be coming out in the relatively near future. I don't have the timing exactly in my head, but there's a report coming out where, amongst other things, we've been looking at the evolutions and assessing whether the legislation needs to be adapted or not. So there is activity in that space. It's on our radar screen, but I don't have a precise timeline for you here today, I'm afraid.
Thank you very
There's one other there, which I think you have to see.
much. Okay, and all the way in the back.
You mentioned a couple of items on your legislative agenda. Do you think they could all be accomplished given the treaties as they are, or do you think that a treaty change would be needed?
Well, I don't think a treaty change is needed. I mean, in a sense, otherwise we wouldn't have proposed them. So the assumption is we propose them on the existing treaty basis. There is a unanimity requirement, which is a high bar to achieve, but we've shown that we can achieve unanimity in tax on difficult issues rapidly, where there is a political will. And there are also provisions in the existing treaty which enable movement to qualified majority voting on, amongst other things, tax questions, if there is agreement to make that move. Again, you need unanimity to make that move, so it's not straightforward, but the possibility exists. So I don't think treaty change is needed. I think it's a question of political will and getting the proposals right.
Thanks. Stephen, in yesterday's communication, there was a description of the problem and then a number of options mentioned. And three of the options were the equalization levy, a withholding tax, and an alternative tax and they all seem to be relating primarily to a gross basis tax on revenue from remote sales, let's say. Can you explain the thinking behind what the difference is between those, among those three, other than nomenclature and to some extent a little bit of scope? I struggle to understand the significance of listing three that seem to be very similar.
Well, I think that passage of the communication was designed to be illustrative of the different types of flavour of ideas that have been floated by various interlocutors about what might be done. I think a lot of them actually flow from the work that was done in BEPS 1. What we want to be doing now on the back of this communication is deepening that discussion and seeing, well, do these ideas make sense? How do people react to them? What do we think is the best way forward? And do we need to go down that path or not? And so it's really, I think the Commission intention there is to open the conversation on that rather than coming into it with a hard and fast idea. And some of those ideas don't necessarily originate in the European Commission. They've come from different interlocutors who have also been active in this space.
I see a hand back there.
Yeah, thanks. Your second point under the growth agenda is preventing double taxation through a new mechanism. Can you talk about what that is?
Yeah, what we did there was we put in place what we call a dispute resolution directive, where what we'd seen, there was already in the legal framework I believe it was a convention on double taxation, which had got us so far, but it wasn't as effective as it might have been. So the directive is designed to provide a vehicle which obliges the member states to go through the different steps of dispute resolution and provide legal outcomes in the judicial process within a clear time frame. And that was, I think, the main innovation in dispute resolution directive, is that it clarified the process and it clarified the timeline and put in deadlines. And what business has been complaining about is that sometimes the disputes can just drag on for years and they don't get judicial redress. So that was the main innovation. We didn't revise all the double tax treaties, we simply provided for a more enforceable dispute resolution process.
So I want to go back to the public CBC reports. So what are some of the concerns that MEPs have about releasing these reports?
You need to ask them. You need to ask them. It's it's issues around commercially sensitive information. It's issues around being caught with different tax authorities trying to tax the same revenue. But by the way, that happens when it's not public. I mean, the issue is there as soon as you have CBCR. But I can't. I mean, to be honest with you, it's basically that they don't want too much information being out in the public domain, and that the scrutiny can sometimes be uncomfortable, and an argument that people, citizens, journalists are not able to understand this stuff. It's too complicated, and so you expose yourself to uncomfortable discussions with an ill-informed public who don't have the specialist knowledge or sophistication to understand what's behind the reporting. I mean, and there I think some effort would need to be made to present the information in a way that was understandable, because it would seem to me to be relevant information for the public space as well. I don't want to be controversial.
So I think I saw two more hands before. Yeah. So I know that you need to leave, so yes. I will take two more questions together and then let you answer. So I know I saw you. I thought I saw a hand over here the last time. Yeah. Okay. So do you want to start with you and go over here, and others can come down for a minute or two afterwards?
Okay, thanks. Can you explain, like in general terms, your proposal regarding VAT, and you think that may help the United States to adopt such tax in the future?
And I was just going to kind of follow up on the point about treaties. If you have a consolidated tax base and you also have this new procedure where a qualified majority can produce tax changes in the tax policy, in looking forward, is it possible that there'll be more discussion of how tax treaties really need to be with the EU because it's the final tax authority and not with member states?
Okay. Can I quickly explain VAT? No, it's really difficult. So the VAT system as it stands has been in place since the 60s, but the current regime since 1992, where it was introduced to align itself with the single market, which came in at the end of 92. And it was designed at that point as a quick fix, as a transitional regime, and it's called a transitional regime, but we're still in it 25 years later. And so what we want to do now is to bring in the cornerstones of what we call the definitive regime. So it's a move to the principle of destination, away from origin to destination, It's closing various loopholes that we've seen in the current legislation. It's simplifying. It's introducing and expanding this one-stop shop concept so that traders can make their VAT returns in a more simplified form, and compliance is simplified. And a general streamlining of the legislation, which has become very, very complex and out of date. Also action to simplify the rates regime and the derogations on the rates, which have become very complex as well. So it's a big piece of work, very sensitive, and VAT is a major revenue source in the European Union. And so it's important to get it right. But it's also important to close off the fraud that is in the system. To give you a number, we estimate the amount of fraud in the EU VAT system to be 50 billion euros a year. And that is money fundamentally that is sucked out of national exchequers, and then someone else is paying it in equivalent taxes somewhere else. The last question, that's a very difficult question on what would happen in CCTB land with tax treaties. And honestly, I need to think about it a little bit. I don't have an instant answer to that question, but maybe we can talk about it offline. But I just need to think it through a bit. I'm sorry to fail at the final hurdle.
Well, thank you very much for being here. This has been a pleasure, and thank you all for being here as well.
Okay, well.
I hope you're